This video is provided for educational and informational purposes only and does not constitute legal, lender, mortgage, loan, real estate, insurance, financial or professional advice. I am not a licensed lender, mortgage, real estate agent, real estate attorney, realtor, broker, financial, loan, insurance, tax, investment or legal professional in the United States. The information shared in this video is based on personal research and publicly available sources. Nothing in this video, or in any related content, creates an attorney-client relationship or any other professional-client relationship between you and me. You should always consult with a licensed professional in your state before making any financial decisions. I make no guarantees regarding the accuracy, completeness, or applicability of the information provided. Any actions you take based on this content are strictly at your own risk. Mortgage requirements in the United States can vary by state, lender, and loan type: FHA, VA, USDA, conventional. You walk out of that lender's office, and the word denied is still ringing in your ears. You did everything right. You served your country with honor, you earned this benefit, you put your life on the line. And now you want to use your VA home loan benefit to buy a home for your family, to own a small piece of the American dream you fought to protect. But a 3-digit number just slammed the door in your face. Your credit score. The loan officer looks at your 580, your 600, maybe even your 615, and tells you to come back in a year after you've fixed it. Feels like a punch to the gut. It feels like the system is rigged against the very people it's supposed to serve. What if I told you that loan officer was wrong? Or at the very least, they didn't tell you the whole story. What if I told you that the single biggest myth in the entire mortgage industry is that you need good credit to get a VA loan? Here is the one sentence that could change everything for you. The U.S. Department of Veterans Affairs does not have a minimum credit score requirement. Let me say that again because it is the most important thing you will hear today. The VA itself, the organization that guarantees your loan, does not look at your application and say, "Sorry, your FICO score is 560. You're out." That is not how it works. So why did that lender deny you? And more importantly, how do you find the lenders who will say yes? That is exactly what this video is for. We are going to rip the curtain back on the entire VA loan process for veterans with bad credit, no credit, or just plain messy credit. We're going to arm you with the knowledge that most lenders hope you never find out. We're going to give you a clear step-by-step blueprint to navigate this system and get you from feeling defeated to holding the keys to your new home. I've seen this exact scenario play out for countless service members and their families. They face down enemies overseas only to come home and face a confusing wall of financial gatekeepers. That ends today. In the next few minutes, you are going to learn the crucial difference between the VA's actual rules and the lender's rules. And that difference is where your power lies. We will break down what lenders are really looking for when your credit score is low. We'll talk about the magic words, compensating factors, and how they can make a low score almost irrelevant. And I will show you exactly what to do if you have collections, charge-offs, late payments, or even a past bankruptcy or foreclosure on your record. So if you've ever been told your credit wasn't good enough, if you've ever felt like homeownership was out of reach, I need you to listen closely. The information I'm about to share could be the key that unlocks the door to your family's future. Let's start with the single biggest lie you've probably been told about the VA loan. It's a myth so pervasive, so deeply embedded in the mortgage world, that it stops thousands of deserving veterans from even trying to buy a home. The myth is that the Department of Veterans Affairs has a minimum credit score requirement. I'm going to say this once clearly so there is no confusion. The VA does not have a minimum credit score. Let me repeat that. The VA itself, the government entity that guarantees your loan, does not look at your FICO score and say, "Nope, a 619 is not good enough. Denied." That's not how it works. Not even close. So if that's true, why were you or your buddy, or someone you know told that you need a 620, or a 640, or even a 660 credit score to get a VA loan? The answer reveals the fundamental misunderstanding that costs veterans their dream homes. The answer lies in the difference between the guarantor and the lender. Think of it like this. The VA is like a rich, supportive uncle. You go to a bank to get a loan for a car. The bank is a little hesitant because you've had some financial bumps in the road. But your rich uncle steps in and tells the bank, "Hey, I know them. They're good for it. In fact, I'll personally guarantee a portion of this loan. If they can't pay for some reason, I'll cover some of your losses." Suddenly, the bank sees you as a much safer bet. They're far more likely to give you the loan, and probably at a better interest rate. In this story, the VA is your rich uncle. They aren't giving you the money directly. A private lender, a bank, a credit union, a mortgage company, is the one actually lending you hundreds of thousands of dollars. The VA simply provides a guarantee on a portion of that loan, which dramatically reduces the risk for the lender. This guarantee is the powerhouse behind the VA loan program. It's why you can get a loan with zero down payment and no monthly mortgage insurance. But here's the critical piece of the puzzle. The bank, the lender, still has its own money on the line. The VA guarantee is powerful, but it doesn't cover 100% of the loan in every default scenario. The lender is still taking a risk. And because they're taking a risk, they get to set their own rules. These internal rules are called lender overlays. An overlay is simply an extra requirement that a lender adds on top of the VA's baseline guidelines. The VA says, we don't have a minimum credit score. But lender A, a big national bank, might look at their internal risk models and say, that's nice, but for our company, we are not comfortable lending to anyone with a score below 640. That 640 score is their overlay. It's not the VA's rule, it's the bank's rule. Then you go down the street to lender B, maybe a smaller mortgage company. They look at their books and decide, we're a bit more flexible. We understand the veteran market. Our overlay is a 620 credit score. And then you find lender C, a company that specializes almost exclusively in VA loans. They live and breathe this program. They understand the nuances, and their business model is built around serving veterans. They might say, we don't have a hard minimum. We've approved loans down to 580, and in some cases even lower. We look at the whole file, not just the score. Do you see what just happened? You just got 3 different answers from 3 different lenders for the exact same loan program. The veteran who gets told no by lender A and gives up, assuming the VA itself has rejected them, just lost their chance at homeownership because of a simple misunderstanding. The veteran who understands that the no came from the lender, not the VA, knows that the game isn't over. The game has just begun. Your mission is not to change your entire life to meet the arbitrary 640 score set by one bank. Your mission is to find the lender whose rules you already meet. It's about shopping, not just for the best interest rate, but for the right lending partner. This is where the real power shifts back to you. Because a low credit score doesn't tell the whole story, and good VA lenders know this. They are trained to look beyond the 3-digit number and search for what are called compensating factors. These are the positive elements in your financial life that help offset the perceived risk of a lower score. They help paint a complete picture of you as a borrower, not just a number. So what are these magic compensating factors? The first, and one of the most important, is residual income. This is a concept unique to the VA loan, and it is your secret weapon. Residual income is the amount of money you have left over each month after you've paid all your major expenses. Your new mortgage payment, taxes, insurance, car payments, credit card payments, and even an estimate for utilities. The VA has a chart that says, based on your family size and where you live, you need a certain amount of residual income to be a safe borrower. If you significantly exceed that minimum threshold, it's a massive compensating factor. It shows the lender that even with a rocky credit past, you have more than enough cash flow to comfortably afford your new home and handle life's little emergencies. A veteran with a 600 credit score but $1,000 a month in residual income can look like a better bet than someone with a 700 score who is living paycheck to paycheck. Another huge compensating factor is your debt-to-income ratio, or DTI. This is simply a percentage that shows how much of your monthly income goes toward paying off debt. If your DTI is low, it's a great sign. It tells a lender you aren't over-leveraged. You have room in your budget. What else do they look for? A history of saving money. Even if it's just a few $1,000s in the bank, it shows financial discipline and that you have a cushion. Stable employment is another big one. Have you been at the same job for 2 or more years? Or at least in the same line of work? That signals stability and a reliable source of income to repay the loan. And here's one that many veterans don't know they can use. A powerful letter of explanation. Your credit report is just data. It doesn't tell the story of the medical emergency that led to collections, or the sudden job loss during a recession, or the messy divorce that wrecked your finances for a year. A letter of explanation is your chance to be human. It's where you explain to the underwriter exactly what happened, why it happened, and most importantly, what steps you've taken to make sure it won't happen again. A well-written letter can be the deciding factor that turns a denial into an approval. Think about Sergeant Johnson. He had a 595 credit score. He went to his local credit union, the one he'd banked with for a decade, and they turned him down flat. said their minimum was $620. He was crushed. He thought that was it. But then he spoke to a lender who specialized in VA loans. This new lender looked deeper. They saw that Sergeant Johnson had been at his civilian job for 8 years. They calculated his residual income and found it was double the VA requirement. He also had $5,000 in savings. The lender then helped him write a letter of explanation detailing how a surprise medical bill for his child a few years back caused his score to drop, but that he had since paid it off and had a perfect payment history for the last 24 months. The big bank saw a $595. The specialist lender saw a stable, responsible veteran who hit a rough patch, recovered, and had more than enough income to be a successful homeowner. Sergeant Johnson closed on his new home 2 months later. The rules didn't change. He just found someone who knew how to properly read the rulebook. So the secret is out. The VA doesn't have a credit score minimum. The power lies with the individual lenders, and your key to success is finding the right lender who looks for reasons to say yes by evaluating your entire financial profile, not just one number. But that raises the most important question of all. How do you find these lenders? In a sea of banks and online mortgage ads, how can you tell the difference between a company that just offers VA loans and a true specialist who will fight for you like Sergeant Johnson's lender did? How do you know what questions to ask to expose the pretenders and find the real experts? Well, the answer is simpler and frankly more empowering than you might think. It all comes down to a simple phone call, a conversation where you aren't the one being interviewed, you are the one running the interrogation. You are armed with a specific set of questions that act like a truth serum. They are designed to instantly expose a company that just lists VA loans on their website like it's another item on a menu, versus a team that lives and breathes the VA home loan benefit. Think of this as your personal lie detector test for lenders. You don't need to be an expert. You just need to ask the right questions and listen carefully to the answers and the hesitations. The first question you ask is the kill shot. It's the one that separates the recruits from the commandos instantly. You ask them this word for word. What are your lender overlays on VA loans? Write that down. Tattoo it on your arm. I'm not kidding. That one question is everything. Now, if you get silence or are confused, what's an overlay? Hang up the phone. Politely, of course. But your search with them is over. They have failed the test. They are not a specialist. If they don't know what an overlay is, they have no business touching a veteran's loan. So what is an overlay? It's the secret, hidden rulebook that gets so many veterans denied. The Department of Veterans Affairs sets the official guidelines. These are the baseline rules for every VA loan in the country. The VA, for instance, has no minimum credit score requirement. 0. It's not in their rulebook. The VA has no maximum debt-to-income ratio, as long as you meet the residual income requirements. But then the lender, the bank, the credit union, the mortgage company adds their own set of rules on top of the VA's rules. These extra stricter rules are called overlays. Think of it like this. The VA posts the official speed limit on the highway at 70 miles per hour. That's the guideline. But a lender can put up their own sign right next to it that says, "Our company policy is 60 miles per hour." They have just created an overlay. They are allowed to be stricter than the VA, but they can't be more lenient. And this is where veterans with bruised credit get crushed. They read online that the VA has no minimum credit score, they get their hopes up, they call the first big bank they see on TV, and that bank says, "Sorry, our minimum credit score for a VA loan is 640. That 640 number? That's not a VA rule. That is a lender overlay. And that loan officer might not even tell you it's their own rule. They might just say, "Sorry, you don't qualify for a VA loan," making you think it's the VA denying you. It's not. It's the bank. So when you ask, "What are your lender overlays?" a true specialist will light up. They'll say, "That's a great question." They'll respect you for asking it. Their answer will be confident and specific. They'll say something like, "We have very few overlays. We don't have a minimum credit score, but we generally need to see a 580 to get an automated approval. Anything below that, we look at on a case-by-case basis with manual underwriting. As for debt to income, we follow the VA's residual income calculation. We don't have a hard cap." See the difference? It's a detailed, expert-level answer. The pretender fumbles. The pro engages. Now, if they pass that first test, you hit them with a follow-up punch. This question confirms they're a true heavyweight. You ask, "What is your process for manual underwriting? And how many manually underwritten VA loans did your team close last month?" This is another landmine for the generalist. Manual underwriting is the art of getting a loan approved when the computer says no. Most lenders feed your application into a computer program, an automated underwriting system, or AUS. It's a black box algorithm that spits out an approved or denied recommendation. If you have a credit score of 750 and no debt, the computer loves you. But if you have a 610 score because of a medical collection from 2 years ago, the computer will likely say denied. Manual underwriting is the human element. It's when an actual person, a living, breathing underwriter, sits down, opens your file, and looks at your whole story. They read your letter of explanation about that medical bill. They see that you've had 24 months of perfect rent payments. They see you have 3 months of savings in the bank. They look at your steady job history. They use common sense. They are allowed to approve a loan the computer rejected, as long as it meets the VA's actual guidelines. A true VA loan specialist loves manual underwriting. It's where they get to be an advocate. It's where they fight for the veteran. They know the guidelines inside and out, and they know how to build a case for you. A generalist lender, on the other hand, hates manual underwriting. It's more work. It's complicated. They don't know the rules well enough to be confident. Many of them simply won't do it. Their policy is, if the computer says no, the answer is no. And the second part of that question, how many did you close last month, is the proof. If they say, oh, maybe 1 or 2, they're just dabbling. If they say, we closed 18 manual underwrites last month, you know you're talking to a team that operates in this world every single day. These first 2 questions will eliminate 90% of the lenders out there. But for the champions who are left standing, you have 2 more questions to make sure you found the absolute best. Question 3. What are your current turn times from loan submission to final approval? This might sound like boring industry jargon, but it's a window into the soul of their operation. A pretender who submits a handful of VA loans a month mixed in with all their other loan types will give you a vague, wishy-washy answer. Well, it depends. It's pretty busy, maybe 30 to 45 days. That's the sign of a clogged, inefficient system where your loan will sit in a pile, waiting for someone who might not know what they're doing. A specialist, a high-volume VA lender, tracks this data obsessively. They are a well-oiled machine. They'll give you a precise, confident answer. Our underwriters are touching new files within 48 hours of submission, and our average contract to close time right now is 21 days. That speed and precision means they have a dedicated team, a streamlined process, and they won't leave you, or your real estate agent, hanging for weeks on end. Finally, the black belt level question. It's subtle, but it reveals everything about their power and influence within their own company. You ask, when a complex file comes up, can you talk directly to your underwriter? Or do you have to submit questions through a computer system? Think about what this means. At a massive call center bank, a loan officer is just a number. They package your file, upload it into a digital void, and pray. If the underwriter, a person they've never met who could be in a different state, has a question, they send a sterile request back through the system. There's no conversation, no advocacy. A true specialist has their underwriter on speed dial. Or better yet, they can walk 20 feet down the hall to their desk. They have a relationship. They can pick up the phone and say, hey Dave, it's me. I'm looking at Sergeant Johnson's file. I know that late payment on the car looks bad, but I have the letter explaining his transmission went out, and I have bank statements showing he paid the $800 repair in cash. Plus, look at his last 2 years of perfect rental history. This veteran is solid. That conversation, that single 5-minute human conversation, is the difference between an approval and a denial. It's the difference between you getting the keys to your home and you getting a soul-crushing rejection email. So there you have it. For questions, the overlay question, the manual underwriting question, the turn time question, and the underwriter relationship question. This is your interrogation guide. It will arm you, empower you, and ensure that the person handling the single largest financial transaction of your life isn't just a dabbler, but a dedicated expert who will go to battle for you. Choosing your lender is more important than choosing your real estate agent. It's more important than the house itself, because the right lender can get you into a home you never thought possible, while the wrong lender can turn your dream home into an impossible nightmare. Now that you know how to find this elite specialist, what do you and that specialist need to know about your credit report? What does the VA actually look at? What kind of bad is a total deal killer? And what kind of bad can be completely overlooked with the right story? We're about to go deep inside the VA's actual credit guidelines, and the answers are going to surprise you. Alright, let's peel back the curtain. The single biggest myth, the one that stops countless veterans from even trying, is the idea of a magic credit score number handed down from the Department of Veterans Affairs. Let me be crystal clear. The VA does not have a minimum credit score requirement. Read that again. The VA, the actual government entity that guarantees your loan, does not set a floor. There is no rule in the official VA lender's handbook that says, if a veteran has a 580, a 600, or even a 619 FICO score, you must deny them. Simply does not exist. So why then does every article, every forum, every lender you call immediately ask about your 3-digit score? Why do they tell you, sorry, we need a 620 to proceed? The answer is a term you absolutely must understand. It's called a lender overlay. Imagine the VA's guidelines are the federal law of the land. They set the baseline rules for the entire country, but then each state, or in this case each lender, can add its own stricter laws on top. That's an overlay. The VA says, we don't have a minimum score. But a lender like Wells Fargo or Rocket Mortgage or your local credit union says, that's nice, but we do. Our company policy, our overlay, is a 620 minimum. Why do they do this? It's all about risk. Remember, the VA doesn't actually lend you the money. The bank does. The VA just provides a guarantee on a portion of that loan. If you default, the lender gets some, but not all, of their money back from the VA. So the lender still has skin in the game. They still have money on the line. To protect themselves, they create these overlays. They use a credit score as a quick, easy black and white filter to weed out what they perceive as riskier loans. It's faster and cheaper for them to just set a hard and fast number than to do the real work of analyzing each veteran's complete financial picture. This is the fundamental conflict. You, the veteran, are playing by the VA's rules, which are flexible and holistic. But you're being judged by the lender's rules, which are often rigid and unforgiving. This is why one lender can tell you no way, while another, with fewer or no overlays, can say let's get this done. So, if the VA isn't just looking at a score, what are they really looking at? They're looking at the whole story. They're looking at what they call the overall pattern of credit behavior. Their guidance to lenders is to look for a clear willingness and ability to repay the loan. This is built on what we can call the foundation of lending, a holistic review of your financial life. Let's get specific. The VA cares deeply about the 12 months leading up to your loan application. This is your recent history, and it's the most important chapter of your credit story. Have you paid all your major bills on time for the last year? Your rent, your car payment, your current mortgage if you have one? If you can show a solid year of on-time payments, that speaks volumes. It tells the VA and the underwriter that whatever happened in the past, you've righted the ship. A 30-day late payment from 3 years ago is a historical footnote. A 30-day late payment from last month is a flashing red light. Next, they look at derogatory credit, the bad stuff. This includes collections, charge-offs, judgments, and liens. The VA doesn't automatically disqualify you for these. Instead, they ask questions. Is it a medical collection? The VA is famously lenient on medical debt. They understand that a medical crisis is often a no-fault situation that can wreck anyone's finances. A $500 medical collection is viewed very differently than a $500 collection from a credit card you simply stopped paying. For non-medical collections and charge-offs, the lender will want to know the story. They'll want to see that you're either paying them off or have a plan in place. A judgment or a tax lien is more serious. These typically must be paid in full before or at closing, because they can attach to the property you're trying to buy. But what about the two big ones? The financial events that feel like a life sentence. Bankruptcy and foreclosure. This is where the VA's flexibility truly shines. Let's talk about a Chapter 7 bankruptcy, the kind that liquidates your debts. Most conventional loans will make you wait 4 years or more. The VA guideline? Typically just 2 years from the date of discharge. 2 years. And even that isn't set in stone. If you can prove the bankruptcy was caused by circumstances beyond your control, like a business failure, prolonged strikes, or a medical emergency, and you've reestablished perfect credit for at least 12 months, some lenders can get an exception approved even sooner. The VA believes in second chances. Now, what about a Chapter 13 bankruptcy? That's the one where you're on a repayment plan. The VA guidelines are even more incredible here. If you've successfully made at least 12 months of your court-ordered payments on time, and you get permission from the bankruptcy court trustee, you can actually get a VA loan while you are still in an active Chapter 13 bankruptcy. This is almost unheard of in the mortgage world, and it is a lifeline for so many veterans who are actively working to rebuild their financial lives. Same story with foreclosure. A foreclosure feels like the end of the road for homeownership. For a conventional loan, you could be waiting up to 7 years. The VA? The standard waiting period is just 2 years from the date the property was transferred out of your name. And just like with bankruptcy, if you can document that the foreclosure was due to a major life event beyond your control, a job loss, a death in the family, a medical crisis, and you've shown solid financial recovery, exceptions can be made. So you see the pattern? The VA is less concerned with the fact that you fell down, and far more concerned with why you fell and how you got back up. This is where your secret weapon comes into play. The letter of explanation, or LOE. An underwriter isn't a robot. They are a person, and the LOE is your one chance to speak directly to them and tell your side of the story. A low credit score or a derogatory mark on your report is just a data point. It's a number. It has no context. The LOE provides that context. It turns a black and white report into a human story. A great letter of explanation has 3 parts. First, you acknowledge the issue head-on. Don't hide from it. Yes, I see the late payments on my auto loan from March to May of 2022. Second, you explain the circumstances simply and honestly. This is not the time for excuses. It's the time for reasons. At that time, my spouse was diagnosed with a serious illness, and I had to take an unpaid leave of absence from work to be their caregiver. Our household income was cut in half unexpectedly. Third, and this is the most critical part, you explain what has changed and how you have recovered. Since returning to work in June of 2022, I have made every single payment on time. We have also built up a 3-month emergency fund to ensure we are prepared for any future unexpected events. That is a powerful story. It shows you're responsible. It shows the problem was temporary and outside of your control. And it shows you've taken concrete steps to make sure it never happens again. That is what an underwriter needs to see to feel confident in approving your loan. They need to be able to justify their decision. Your LOE gives them the justification they need. It gives them the why behind their approval. So the VA is looking at your recent payment history, the story behind your derogatory credit, and your documented recovery from major financial events. They are looking for a borrower who has demonstrated a renewed commitment to financial responsibility. They're looking for a good risk, not a perfect credit score. The score is just the beginning of the conversation, not the end. But knowing this is only half the battle. You can have the most compelling story of recovery in the world, a perfect letter of explanation, and a file that fits the VA's true guidelines perfectly. But it means nothing if you can't get past the gatekeeper. The loan officer at a rigid bank who sees your 615 credit score and says, "Computer says no," before you even get to tell your story. How do you find the lenders who throw out the overlays? How do you connect with the loan officers who actually know the real VA rulebook inside and out and are willing to fight for you? Well, the answer isn't a secret website or a magic phone number. It's a strategy. It's a battle plan. And it starts by understanding where not to look. Your first instinct might be to walk into the massive, marble-floored National Bank on the corner, the one you have a checking account with. Or maybe you'll click the first flashy ad that pops up on Google promising instant VA loan pre-approval. Both of these are almost certainly the wrong move. Think about it. Big, national banks are battleships. They are powerful, they process a massive volume of loans, but they turn slowly. Their entire business model is built on speed, efficiency, and standardization. They need to process thousands of applications a day. To do that, they rely almost exclusively on automated underwriting systems. That AUS, that computer algorithm, is their god. If your file doesn't fit neatly into its pre-programmed boxes, if your credit score is a 595 instead of their required 640, the computer spits it out. The loan officer you talk to is often just an order taker. They don't have the authority, the training, or frankly, the time to fight the machine for you. To them, you're just one of 1,000 applications, and it's easier to say no and move to the next one than it is to do the hard work of a manual underwrite. Those online only, click here for instant approval lenders are often even worse. They are the fighter jets of the mortgage world. All speed, no substance. Their goal is to get you in the system, get your data, and close the easiest possible loans as fast as possible. They are the kings of overlays because it makes their business model work. They aren't equipped for nuance, for stories, for the human element of your financial life. So where do you go? You go hunting. But you're not hunting for a company. You're hunting for a person. You are looking for a specific type of loan officer, a specialist, a craftsman, a VA loan expert who works for a lender that gives them the freedom to actually do their job. These experts are often found at smaller, more agile mortgage banks, credit unions, or working as independent mortgage brokers. Why? Because their business model is different. A mortgage broker, for instance, isn't tied to one set of rules. They have access to dozens of different lenders, each with slightly different guidelines. They know which lender is more lenient on credit, which one is great with self-employed veterans, and which one will manually underwrite a tough file. Their job isn't to serve the bank. Their job is to serve you by finding the right bank for your specific situation. Similarly, many smaller mortgage banks and credit unions build their reputation on service, not volume. They empower their loan officers to be problem solvers. They understand that a veteran with a 580 score due to old medical collections from a service-related injury is a fantastic and deserving borrower. They are willing to do the work, to look past the numbers and see the person. So, your mission is to find these people. You start by changing your search terms. Stop Googling VA loan lender. Start Googling phrases like VA loan manual underwriting specialist, VA loan lender no credit score overlay, mortgage broker specializing in VA loans. Add your state to the search to narrow it down. You're sending up a flare. And these specific keywords are designed to attract the experts and repel the automated factories. Once you have a list of names and numbers, the real work begins. You are now the hiring manager. You are going to interview these loan officers, and you're not going to let them off the hook with slick sales pitches. You need to come prepared with a very specific set of questions. This is your playbook. Grab a notepad. The first loan officer you call, you start the conversation like this. Hi, I'm a veteran looking to use my VA home loan benefit. I'm interviewing a few loan officers to find the right fit. I have a couple of specific policy questions for you before we dive into my personal information. Is now a good time? This framing is critical. It immediately establishes that you are in control. You are savvy. You are not a desperate buyer. You are a discerning client. Now, here is question number 1, the most important question you will ask. What are your company's lender overlays for VA loans, specifically regarding credit scores? Listen very carefully to the answer. If they immediately say, our minimum score is 640, or we need a 620 to get started, thank them for their time and hang up the phone. You have your answer. They use overlays. They are not the lender for you. You just saved yourself weeks of frustration. If they hesitate or say something vague like, well, it depends on the file, press them. Say, I understand that, but I'm asking about a hard floor. Does your company have a minimum credit score requirement, below which you will not accept a VA loan application, regardless of other factors? The golden answer, the one you are listening for, sounds something like this. The VA doesn't actually have a minimum credit score requirement, so we don't either. We underwrite based on the full VA guidelines. We look at the entire file and focus on your ability to repay the loan. When you hear that, you found a potential champion. That's a massive green flag. But you're not done. Question number 2. How many VA loans for borrowers with credit scores under 600 have you personally closed in the past year? This question separates the theorists from the practitioners. A loan officer can know the rules, but have they ever actually navigated a tough file through the system? A great LO will be able to answer this confidently. They might say, oh, a bunch. I just closed one last month for a veteran with a 585 score who had some old charge-offs. They might even tell you a bit about how they got it done. That's experience. That's who you want in your corner. If they stumble, say, I'd have to check. Or we don't really see many of those. They're telling you they're a rookie in this specific arena. They might be a great loan officer for a borrower with an 800 score, but they're not your guy. On to question number 3, the expert-level question that shows you've done your homework. Can you walk me through your process for a manual underwrite on a VA file? A bad loan officer will get flustered. They'll give you jargon or say, oh, that's something the underwriters handle. Wrong answer. A true expert will light up. They'll welcome the question. They'll say something like, absolutely. First, we're going to put together a strong loan application, but the real work is in the details. I'm going to ask you for a detailed letter of explanation for any past credit issues. We'll then work together to document what the VA calls compensating factors. We'll focus on showing your strong rental history, your low debt-to-income ratio, and the fact that you have money in savings. My job is to build a narrative for the underwriter that proves, beyond a shadow of a doubt, that the credit score doesn't tell your whole story, and that you are not an unacceptable credit risk. This answer shows they don't just push paper, they build a case. They are your advocate. Finally, question number 4. In your experience, What are the most powerful compensating factors for getting an approval on a low-score VA file? This is you asking them to show off their expertise. You're looking for specific, concrete answers. They should mention things like a large amount of residual income left over each month, a very low debt-to-income ratio, a significant amount of cash in savings or retirement accounts, a long and stable job history, or a history of paying rent that's equal to or greater than the proposed new mortgage payment for at least 12 months. If they can rattle these off and explain why they matter to an underwriter, you've hit the jackpot. This interview process flips the entire script. It takes you from a position of weakness, hoping someone will give you a chance, to a position of power, selecting the best possible expert to join your team. Don't be afraid to call 5, 10, even 15 lenders. This is the single most important decision you will make in the entire home buying journey. Finding the right loan officer is more important than finding the right house. Because the right loan officer is the one who gets you the keys to any house. So you've done it. You've run the gauntlet. You've dodged the automated no machines and the inexperienced rookies. You've found a loan officer who knows the real VA rulebook, who has the experience, and who works for a lender that believes in manual underwriting. You've found your champion. Now it's time to arm them for battle. And the most powerful weapon in your arsenal is something the VA calls compensating factors. Compensating factors. It sounds like boring lender jargon, but I want you to think of them differently. I want you to think of them as the story behind the numbers. Your credit score? That's the headline. It might be a messy one, maybe even a scary one, but it's not the whole story. Compensating factors are the other chapters. They are the undeniable, positive truths about your financial life that an underwriter can use to justify approving your loan, even when the automated system screams, no. The entire philosophy of the VA loan program is built on one core idea: to look at the veteran as a whole person, not just a 3-digit number. While conventional loans are often run by rigid algorithms that see black and white, the VA encourages a human touch. It encourages underwriters to look for the shades of gray, to find the reasons to say yes. Compensating factors are those reasons. They are the evidence you and your loan officer present to the underwriter to prove that you are a reliable borrower and a good risk, despite what happened in the past. They don't just excuse bad credit, they overpower it. So what are these powerhouse factors? Let's break down the most important ones, starting with the absolute king of them all: residual income. Now, you've probably heard of debt-to-income ratio, or DTI. That's a simple calculation. Your total monthly debt payments divided by your gross monthly income. It's important, but for the VA, it's not the main event. The VA is obsessed with something much more practical: residual income. This is the amount of money you have left over each month after you've paid all your major expenses, including your new mortgage payment, taxes, insurance, utilities, and all your other debts listed on your credit report. This is your actual real-world living and breathing money. It's the cash you have for gas, for groceries, for an unexpected car repair, for life. The VA has a specific guideline for the minimum amount of residual income a family needs, and it varies based on your family size and the region of the country you live in. But here's the secret: merely meeting that minimum isn't the goal. The magic happens when you exceed it significantly. Let me paint a picture for you. Imagine two veterans, both with a 590 credit score. Both want to buy a house with a $2,500 monthly payment. Veteran A makes $6,000 a month. After his new mortgage and other debts, he has $700 left over. He meets the VA's minimum residual income guideline for his family size, which is, let's say, $650. He's barely scraping by the requirement. Now look at veteran B. She also has a 590 credit score, but she makes $9,000 a month. After her identical $2,500 mortgage and her other debts, she has $2,000 left over. Her residual income is more than 3 times the VA requirement. Who do you think the underwriter sees as a safer bet? It's not even close. Veteran B's massive residual income is a powerful compensating factor. It tells the underwriter that even if she has a financial hiccup, a medical bill, a pay cut, she has a huge cushion. She can absorb the shock without missing a mortgage payment. A high residual income is the single most compelling piece of evidence you can present to argue that your past credit issues are truly in the past. Next up, let's talk about cash reserves. This is another heavyweight champion in the world of compensating factors. Cash reserves are the funds you have in the bank, in checking, savings, or other easily accessible accounts. Asterisk after asterisk, you've paid all your closing costs and prepaid expenses. This is your emergency fund. And the more you have, the better your story gets. Think of it from the lender's perspective. If a borrower with a low credit score has drained every last penny to get into the house, what happens if the water heater breaks in the first month? Or they have a dental emergency? They're on a financial knife's edge. But if that same borrower has 6 months' worth of mortgage payments sitting in a savings account, that's a safety net. It's a sign of financial stability and foresight. It tells the underwriter that you are prepared for the unexpected. How much is enough? There's no magic number, but having 3 to 6 months of pity, that's your full monthly payment of principal, interest, taxes, and insurance, is a fantastic goal. Having more than 6 months can be a game changer. It demonstrates a level of financial health that can make a low credit score seem like an old, irrelevant data point. The third critical factor is a stable and reliable employment history. This isn't just about having a job. It's about the story your career tells. Have you been with the same employer, or at least in the same line of work for 2 years or more? Have you shown a history of promotions, pay raises, or increased responsibility? This paints a picture of dependability. It shows you're not a flight risk, either in your career or, by extension, your financial obligations. This is especially important if your income isn't a simple salary. If you're a commission salesperson, self-employed, or work a job with a lot of overtime, a 2-year history of consistent or, even better, increasing income is pure gold. It proves your earning potential is not a fluke. It's a reliable trend. An underwriter sees that stability and thinks, okay, the credit took a hit, but their income is a rock. They can handle this mortgage. Now let's circle back to that debt-to-income ratio. While the VA is more focused on residual income, having a very low DTI is still a fantastic compensating factor. The VA doesn't have a strict DTI cap like other loan programs, but if your credit is bruised, a high DTI is a red flag. Conversely, a DTI of say 35% or lower is a huge green flag. It shows that you're not overextended. A large portion of your income is free and clear, which, when combined with strong residual income, creates an almost unbeatable argument for your financial stability. Another factor that works hand in hand with this is a demonstrated history of saving. This is different from just having cash reserves. This is about showing a pattern of responsible financial behavior over time. Are you consistently contributing to a 401k or a thrift savings plan? Do your bank statements show regular, automatic transfers into a savings account? This pattern tells the underwriter that you have financial discipline. It proves that whatever caused the credit problems in the past, your current habits are those of a responsible saver. You are building wealth, not just living paycheck to paycheck. Finally, and this might sound counterintuitive for a loan famous for requiring no down payment, but making a down payment. While you absolutely don't have to, choosing to put down 5% or even 10% on a VA loan is one of the most powerful statements you can make. It does 2 things. First, it shows you have skin in the game. You are financially invested in the property from day one. Second, it reduces the lender's risk. The less they have to lend you, the more comfortable they become. For an underwriter on the fence about a low credit score, a significant down payment can be the one thing that pushes your file from the maybe pile straight into the approved stack. These factors rarely exist in isolation. The real power comes when you stack them. Imagine the story you can tell. Yes, my credit score is 585 because of a medical issue 3 years ago. But look at this. I've been at my job for 5 years with consistent raises. My residual income is double the VA requirement. I have 8 months of mortgage payments saved up in the bank after closing, and I'm putting 5% down. That's not a story about bad credit. That's a story about resilience, responsibility, and recovery. That is a story an underwriter can believe in. That is the story that gets you the keys to your new home. So, how do you actually tell that story? It's not like you can get the underwriter on the phone and plead your case. You tell it through something called a letter of explanation, or an LOX. And I need you to listen very carefully here, because most people treat this letter like a homework assignment they have to get through. They see it as a nuisance. That is a massive mistake. The letter of explanation is not a formality. It is your closing argument. It is your one chance to speak directly to the human being on the other side of the desk and transform yourself from a set of numbers on a page into a real person with a real story. A poorly written letter can sink your loan. A brilliantly written one can save it. So what does a brilliant letter of explanation look like? It has 4 simple parts. Part 1, acknowledge and own. Do not make excuses. Do not blame anyone else. Start by clearly and concisely stating the issue. For example, This letter is to explain the late payments on my credit card from June to September of 2021. That's it. Simple, direct, and it shows you're taking responsibility. Underwriters read excuses all day long. What they respect is ownership. Part 2, the context. This is where you explain what happened. But again, be factual, not overly emotional. You're not writing a screenplay. You're providing context for a financial decision. During that time, my spouse was in a serious car accident, which resulted in unexpected medical bills totaling over $10,000 and a temporary loss of their income. To cover these essential costs, we had to prioritize medical payments, which unfortunately led to a 90-day delinquency on our credit card. See the difference? It's not, "Oh, it was a terrible time, we were so stressed out." It's a factual account of an extenuating circumstance. It's the why behind the what. Part 3, the recovery. This is the most important part of the entire letter. This is where you prove that the problem is in the past and will not happen again. This is where you show your work. Don't just say, "Everything is fine now." Demonstrate it. For example, to resolve this situation, we immediately entered into a payment plan with the creditor, which was paid in full by January of 2022. We also completed a financial literacy course, created a detailed monthly budget which we have followed for 18 consecutive months, and have since built an emergency fund of $6,000 to prevent a similar situation in the future. Boom! You've just shown the underwriter that not only did you fix the problem, you took concrete, verifiable steps to ensure it's a non-repeating event. You didn't just weather the storm. You rebuilt the ship stronger than it was before. And finally, part 4, the current stability. This is your conclusion. Briefly summarize your present financial strength. Currently, I have been with my employer for 4 years, have received consistent raises, and have maintained a perfect payment history on all obligations for the past 24 months. We are financially stable and fully prepared for the responsibilities of homeownership. You put those 4 parts together, ownership, context, recovery, and stability, and you have crafted a narrative that an underwriter can get behind. You've taken a red flag on your credit report and turned it into a testament to your resilience. Now that letter provides the powerful why behind the numbers. But a great story with bad numbers still won't fly. So let's talk about the single most important set of numbers in your VA loan application after your credit score. I'm talking about your debt-to-income ratio, or DTI, and its secret weapon cousin, residual income. Your DTI is exactly what it sounds like. It's a percentage that shows how much of your monthly gross income, that's your income before taxes, is eaten up by your monthly debt payments. We're talking about car loans, student loans, credit card minimum payments, personal loans, any installment debt. Your lender adds all those up, then divides it by your gross monthly income. Let's use an easy example. Say you're a staff sergeant earning $6,000 a month before taxes. And let's say your monthly debts are a $500 truck payment and a $300 student loan payment. That's $800 in total debt. The lender takes $800, divides it by 6,000, and gets about 13.3%. That's your DTI. Now, the VA has a general guideline that they prefer to see a DTI of 41% or less. And this is where a lot of veterans get scared. They do the math, they see they're at 45% or 48%, and they think it's game over. But here is one of the most powerful and misunderstood advantages of the VA loan. That 41% is a guideline, not a guillotine. It is not a hard and fast rule. And the reason it's not a rule is because the VA cares about something much more important than your DTI. They care about your residual income. Residual income is the VA's secret weapon. No other major loan program uses it, and it is the #1 reason veterans with less than perfect credit or higher DTI can still get approved. Residual income is the amount of money you have left over each month after you've paid all your major obligations, including your new estimated mortgage payment, property taxes, homeowners insurance, utilities, and all the debts we just talked about. It's the VA's common sense test. They're not just asking, can this veteran pay their mortgage? They're asking the real question. After the mortgage and all other bills are paid, does this veteran and their family have enough money left over to actually live? To buy groceries, put gas in the car, buy clothes for their kids, and handle minor unexpected expenses without going into financial distress. The VA has a table that sets minimum residual income requirements. These vary based on your geographic location and the size of your family. For example, the VA might say that a family of 4 living in the Midwest needs to have at least $1,003 left over each month to be considered financially stable. For a family of 4 in the more expensive Northeast, that number might be $1,092. This is where the magic happens. Let's go back to our staff sergeant. Let's say with their new mortgage payment, their DTI is actually 48%, which is well over that 41% guideline. A conventional loan would likely deny them on the spot. But the VA lender keeps going. They calculate the residual income. They take that $6,000 in gross monthly income, subtract taxes, subtract the debts, subtract the new mortgage payment and utilities, and they find that this family has $1,500 left over at the end of the month. The VA requirement for their family size and region might only be $1,000. Since they have $1,500 left over, a full $500 more than the minimum requirement, they have what's called a strong residual income. And in the world of VA loans, a strong residual income can beat a high DTI almost every single time. The underwriter sees that even though a large percentage of their income is going to debt, they still have more than enough money to live comfortably. They are not a risk. They are a safe bet. That loan gets approved. This is what we call a compensating factor. It's a major strength in your loan file that helps to offset a weakness, like a lower credit score or a high DTI. And strong residual income is the king of all compensating factors. Other things can help too. Having a significant amount of cash in the bank after closing, what we call reserves, is a huge compensating factor. A long, stable history of employment in the same field is another. A documented history of paying rent that's equal to or greater than your new mortgage payment shows you can handle the expense. This is how the system is designed to work. It's not about finding a reason to say no. It's about building a complete picture of you as a borrower. Your credit score is just the opening chapter. Your letter of explanation provides the backstory. And your DTI and residual income tell the story of your current financial life. If you have a low credit score but you can write a compelling LOX, show strong residual income, and maybe have a few months of reserves in the bank, you have built a powerful case for yourself. You've shown that you are more than just a 3-digit number. So we've covered the story you need to tell, and the numbers you need to hit. But what about the property itself? Because even with a perfect credit story and flawless financials, the house you choose has its own set of strict requirements that can make or break your VA loan. And that's exactly what we're diving into next. The VA isn't just guaranteeing a loan for you. They're guaranteeing a loan on a specific piece of property, and they have a vested interest in making sure that property is a good, solid, safe investment. This is where we run into something called the VA Minimum Property Requirements, or MPRs. Think of it as the house's own credit score. It has to pass the test or the loan stops dead in its tracks. To understand this, let's step into the shoes of a hypothetical veteran. We'll call him Mark. Mark has done everything right. He's saved his money, worked on his credit, got his certificate of eligibility, and found a great lender. He's pre-approved and ready to go. After weeks of searching, he finds it. The one. It's a charming older home, built in the 1960s with great bones, a big backyard for his dog, and tons of character. He puts in an offer, it's accepted, and he's ecstatic. The next step is the VA appraisal. Mark thinks this is just a formality to confirm the price. He is about to learn it is so much more. The VA appraiser isn't just there to determine the home's value. They are the VA's eyes and ears on the ground, and their primary mission is to ensure the property meets those minimum property requirements. These MPRs can be boiled down to 3 core principles, the 3 S's: safety, soundness, and sanitation. Let's start with safety. Mark loved the character of his dream house, but to the VA appraiser, that character looks a lot like risk. The first thing the appraiser notices is the exterior paint. It's peeling and flaking off the old wooden window frames. To Mark, it's a weekend project. To the VA, because the house was built before 1978, it's a major red flag for lead-based paint. Lead paint is a serious health hazard, especially for children. The VA will not guarantee a loan on a home that poses a direct health risk to the veteran and their family. So that peeling paint, it has to be scraped, properly disposed of, and repainted before the loan can close. The appraiser then walks inside. He flips a light switch in the hallway, and the lights flicker. He notes exposed wiring in the unfinished basement. This isn't just an inconvenience, it's a fire hazard. The electrical system must be safe and in good working order. He heads up the steep basement stairs and notices there's no handrail. A simple thing, right? But it's a major fall risk. The VA says any staircase with more than a few steps needs a handrail. Safety is non-negotiable. Broken window panes, missing smoke detectors, evidence of active pest infestations like termites. All of these are safety issues that will be flagged and must be repaired. The VA's goal is to ensure that the day a veteran moves in, they are moving into a home that is fundamentally safe to live in. Next up is the second S, soundness. This is about the structural integrity of the home. Is it built to last, or is it falling apart? Mark noticed the floors in the living room had a slight, charming slope. The VA appraiser sees something different. He sees a potential foundation issue. He goes into the crawl space with a flashlight and finds cracked support beams and evidence of water damage. This isn't character. It's a structural defect. The VA will not back a loan on a property with a failing foundation. The very ground the house sits on must be stable, with proper drainage to ensure water flows away from the foundation, not into it. Then the appraiser looks up. The roof. Mark thought the mismatched shingles looked rustic. The appraiser sees a roof that is at the end of its life, with curled shingles and signs of active leaks in the attic. The VA requires that the roof be in good condition and have a reasonable amount of life left. They won't approve a loan on a house where the veteran will immediately be hit with a $10,000 or $20,000 roof replacement bill. The home has to be structurally sound from the foundation to the roof. This also includes things like ensuring the property has adequate access from a public or private street. You can't have a landlocked property, and that it's free from significant hazards like being in a designated avalanche or mudslide zone. Finally, we have the third S, sanitation. This is about the basic modern necessities of a livable home. The property Mark wants to buy has a well and a septic system instead of city water and sewer. The VA appraiser will require proof that these systems are working properly. A water test will be ordered to ensure the well water is safe to drink, free from contaminants like bacteria. The septic system will need to be inspected to confirm it's functioning and not failing. The VA is protecting the veteran from moving into a home where they can't safely drink the water or flush the toilet. Sanitation also covers the home's mechanical systems. The heating system must be adequate to make the home comfortable in its climate. An old, failing furnace that can't keep the house warm in a cold winter won't pass. In warmer climates, a lack of a permanent cooling system might be flagged if it's considered standard for the area. The home must have a continuous supply of hot water. These aren't luxuries, they are fundamental requirements for a sanitary, livable dwelling. So the appraiser finishes his inspection of Mark's dream home. A week later, the report comes back. It's called a Notice of Value or NOV, and it's not good news. The appraiser has flagged the peeling lead paint, the faulty wiring, the missing handrail, the leaky roof, the questionable foundation, and has called for inspections of the well and septic systems. The report essentially says, this property in its current condition is not eligible for a VA guaranteed loan. Mark is devastated. He thinks he's lost the house. He thinks the VA has rejected his dream. But this is a critical moment to understand. The VA didn't reject Mark. It protected him. The appraisal process just saved him from buying a potential money pit. A home with tens of thousands of dollars in immediate, necessary, and dangerous repairs. So is the deal dead? Not necessarily. This is where negotiation begins. The Notice of Value lists every single repair that must be completed for the loan to be funded. Mark now has a powerful tool. He can go back to the seller with this official report and say, I want to buy your house, but according to the standards of the U.S. Department of Veterans Affairs, these specific items must be repaired before we can close. The most common outcome is that the seller agrees to make the repairs. They hire contractors, fix the roof, scrape and paint the window frames, install a handrail, and have an electrician fix the wiring. The appraiser then comes back out to verify the work is done, and if it is, the loan can proceed. What if the seller refuses? Mark still has options. He could potentially negotiate a lower price to cover the cost of repairs, though financing that can be complex. Or, and this is often the wisest choice, he can walk away from the deal, his earnest money deposit protected by his financing contingency. He lost that specific house, but he was saved from a potential financial disaster. The NPRs acted as a built-in mandatory home inspection that protected his biggest investment. The minimum property requirements aren't there to make a veteran's life difficult. They exist for one reason: to protect the veteran. They ensure that the home you buy with your hard-earned VA benefit is safe, sound, sanitary, and a good investment for your future. Now Mark's story had a happy ending. The seller agreed to the major repairs, the appraiser signed off, and he got his home. But the appraiser's job wasn't quite done. After confirming the house was safe and sound, he had one more number to deliver: the actual appraised value. And what happens when that number, the professional opinion of what the house is truly worth, comes in lower than the price you agreed to pay? That's a whole different kind of crisis, and it happens more often than you think. This is the moment your dream home purchase can completely implode. The bank, your VA-approved lender, will only finance a loan for the appraised value of the home, not a penny more. So if you agreed to pay $400,000, but the appraiser says the house is only worth $390,000, the bank will only give you a loan for $390,000. That $10,000 difference? That's the appraisal gap. And it's a chasm you're now staring into, with the seller on one side and your lender on the other, and you're stuck right in the middle. Suddenly, you need to find $10,000 in cash, or the entire deal is dead. Let's make this real. Imagine a staff sergeant, we'll call him David. He and his family are PCSing to a new base in a hot market. They find the perfect house, great schools, short commute. But it's a bidding war. They stretch their budget and offer $425,000. The seller accepts. They're ecstatic. They've told their kids, they've picked out rooms, they're mentally moving in. The lender pre-approved them, everything looks golden. Then the call comes. The VA appraisal came in at $410,000. A $15,000 gap. David's heart sinks. They don't have an extra 15 grand just sitting around. This is the exact moment where so many veterans feel like their dream is slipping through their fingers. But this is also where the VA loan process reveals one of its most powerful and least known secret weapons. Before you even get to the negotiation stage, the VA has a unique process built in to try and prevent this exact crisis. It's called the Tidewater Initiative. This is critical information. If a VA appraiser inspects a home and suspects, based on their initial analysis, that the value is going to come in lower than the agreed-upon sales price, they are required to pause everything. They don't just submit the low appraisal and blow up the deal. Instead, they invoke Tidewater. They notify the lender's point of contact, who is usually the loan officer, and say, "I'm having trouble reaching the contract price. You have 48 business hours to provide me with the best comparable sales you can find to support this value." This triggers a frantic 2-day scramble. Your real estate agent, the seller's agent, and your loan officer all spring into action, digging through recent sales in the neighborhood, looking for any legitimate comparable home sales that the appraiser might have missed. Maybe a house down the street sold for more, but the sale wasn't publicly recorded yet. Maybe a comp the appraiser used was a foreclosure, which isn't a fair comparison. They gather all this evidence and submit it back to the appraiser within that 48-hour window. The appraiser is then required to review this new data before finalizing their report. Sometimes, this new information is enough for them to adjust their valuation upwards to meet the contract price. The crisis is averted before it even officially began. It's a built-in second chance, a life raft that doesn't exist in most conventional loans. But what if Tidewater is invoked? You submit the comps, and the appraiser still stands firm. The final appraisal is issued, and it's low. The gap is real. Now what? You're not out of options yet. The next step is a formal appeal called a reconsideration of value, or ROV. This is different from Tidewater. This is you, after the fact, formally challenging the appraiser's conclusion. To do this, you can't just say, "I think it's worth more." You have to provide cold, hard facts. You need to demonstrate that the appraiser made a material error. Maybe they listed the house as having 3 bedrooms when it has 4. Maybe they got the square footage wrong. Or, you can present new, truly compelling comparable sales that were somehow missed by everyone. The ROV is submitted to the VA, who then manages the process. Can be a long shot, and it takes time, but it is an available option. More often than not, however, the solution lies in the art of negotiation. That low appraisal, as gut-wrenching as it is, just became your single greatest bargaining chip. Your agent can now go back to the seller's agent with a very powerful argument. "Look, this isn't just our opinion. A professional, third-party, VA-certified appraiser has determined that your home's fair market value is $15,000, less than our contract price. Any other VA buyer is going to run into this exact same problem. So you can work with us, or you can put your house back on the market and likely face the same low appraisal with the next veteran who comes along." This puts immense pressure on the seller. From here, a few things can happen. In a best-case scenario for you, the seller gets spooked. They don't want to start the whole process over. They agree to lower the sales price all the way down to the appraised value. David's $425,000 house is now a $410,000 house. The deal is saved and he just got a $15,000 discount. It's a fantastic outcome. Alternatively, the seller might refuse to budge. They might say, take it or leave it. I'll wait for a cash buyer who doesn't need an appraisal. In a seller's market, this can happen. This leads to the third and most common outcome: you meet in the middle. The seller agrees to drop their price by half the gap, say $7,500, if you can come up with the other $7,500 in cash. This is where having some savings becomes absolutely critical. And that brings us to the next option: you pay the entire difference yourself. The VA actually allows this. If David can scrape together that $15,000, he can choose to pay it at closing. The loan will be for the $410,000 appraised value, and his cash will cover the rest to get to the $425,000 sales price. But this is a tough pill to swallow. You're knowingly and willingly paying more for a house than it is officially worth on paper. You're starting out with negative equity. For many, this isn't just financially difficult, it feels wrong. This is where your credit score and financial situation circle back into the picture. A buyer with a 780 credit score and $50,000 in the bank has options. They can confidently negotiate, knowing they have the cash to bridge a gap if needed. But a veteran with a 620 credit score and barely enough for closing costs has almost no leverage. Their ability to pay the difference is zero. Their entire hope rests on the seller agreeing to lower the price. If the seller says no, their only remaining option is the hardest one of all. You walk away. Almost every real estate contract includes an appraisal contingency. This clause is your escape hatch. It states that if the property does not appraise for the contract price, and a new price cannot be agreed upon, the buyer can cancel the contract and, most importantly, get their earnest money deposit back. It's a heartbreaking decision. You've invested weeks of your life and emotional energy into this home. But the VA appraisal did its job. Its primary function isn't to make the deal work. It's to protect you, the veteran. It prevents you from overpaying for a property and getting into a financially dangerous situation. For a buyer with a shakier credit history, this protection is not a bug. It's an essential feature. It forces a financially sound decision, even when it's an emotionally painful one. So you've navigated the credit score maze, you've conquered the appraisal gap, and you think you're home free. The finish line is in sight. But there's one final nerve-wracking step where it can all still fall apart. It's the final review by the underwriter, the person with the ultimate power to say yes or no. And they're about to look at your file one last time with a magnifying glass, looking for any last-minute changes that could torpedo your entire loan. This is the moment of truth. The underwriter pulls up your file and their job is simple. Verify that nothing has changed since your initial approval. They're running one last credit check. They're re-verifying your employment. They're looking at your bank statements again. They are searching for red flags. And the biggest red flag of all? You doing something you shouldn't. This period between conditional approval and the final clear to close is where more deals die than you can possibly imagine. It's the financial equivalent of the last 100 yards of a minefield. You've made it 99% of the way, and one wrong step can blow everything up. So listen very, very carefully. This is arguably the most important advice in this entire series. From this moment until you have the keys in your hand, you are on complete financial lockdown. Do not, and I mean do not, do any of the following. First, do not apply for any new credit. Period. Don't open a new credit card to get 10% off that new lawnmower you're eyeing for your future backyard. Don't finance a new washer and dryer set because the sale is just too good to pass up. Every time you apply for credit, it creates a hard inquiry on your report, which can ding your score. But more importantly, the underwriter will see it. They will see that new inquiry and their first question will be, what is this? Did they open a new account? Did they take on new debt? This forces them to stop everything, investigate, and recalculate your debt-to-income ratio. If that new payment pushes your DTI over the limit, your loan is denied. Just like that, the deal is dead. All for a 10% discount. It is not worth it. Second, do not buy a new car. This is the #1 killer of mortgage approvals. I cannot tell you how many people I've seen get approved for a home, and then in a fit of excitement, they drive down to the dealership and trade in their old sedan for a brand new truck. They sign the papers thinking, I'll just roll this into my new life. What they just did was add a $600, $700, or $800 monthly payment to their debt load. Their DTI skyrockets. The underwriter sees the new loan, reruns the numbers, and slams the denial stamp down so hard it shakes the desk. You can buy the car after you close on the house. not 1 second before. Third, do not change jobs or quit your job. Lenders need to see stable, reliable income. If you suddenly switch employers even for a better paying job, it throws a massive wrench in the works. The underwriter has to re-verify everything from scratch. They need new pay stubs, they need to call the new employer, they need to confirm your new salary and employment terms. If there's a probationary period at your new job, you might be instantly disqualified. The safest bet is to stay put until after you've moved in. Fourth, do not make large, undocumented cash deposits into your bank account. The lender is tracking every penny. If $10,000 suddenly appears in your checking account, they have to source it. They have to prove it's not a secret, undisclosed loan from a friend or family member that you'll have to pay back. If your parents are gifting you money for closing costs, that's fine, but it needs to be documented with a proper gift letter. Selling your car for cash? You need a bill of sale. That mattress money you've been stashing? It's a liability now. Keep your accounts clean and predictable. And finally, do not co-sign a loan for anyone. Not for your brother, your cousin, or your best friend. When you co-sign, you are legally responsible for that debt. In the eyes of the underwriter, that is your debt. It gets added to your DTI, and it can absolutely disqualify you from your own mortgage. Think of it this way, your financial life is now a photograph. From the moment you get that conditional approval, the underwriter has a snapshot of your finances. Their final job is to make sure the real you still matches that picture when it's time to sign. Any change, new debt, new job, new inquiries blurs that picture, and underwriters do not approve blurry pictures. You wait. It might be a day, it might be a week. It's agonizing. You check your email 100 times a day, and then it happens. An email or a call from your loan officer. 3 magical words. You're clear to close. That is the signal. That is the green light. It means the underwriter has given their final blessing. All the documents have been checked. All the conditions have been met, and the lender is officially ready to fund your loan. The feeling is pure, unfiltered relief. It's the moment you finally know for certain that this is real. You are going to be a homeowner. From there, things move fast. You'll be scheduled for your closing. This is the final meeting where you sign the mountain of paperwork that officially transfers the property to your name. You'll sit at a table with a closing agent or attorney, and you'll sign your name until your hand cramps. You'll sign the promissory note, agreeing to repay the loan. You'll sign the mortgage or deed of trust, which secures the property as collateral. You'll review the closing disclosure form one last time, which itemizes every single cost associated with the loan. And when the last page is signed, they hand you the keys. That's it. That's the moment. The culmination of everything we've talked about. The credit checks, the income calculations, the letters of explanation, the underwriting, the waiting. It all leads to that small metal object being placed in your hand. The key to your front door. As we wrap this up, I want you to take a step back and look at the big picture. We started this journey talking about bad credit. We talked about a number, a 3-digit score that can feel like a judgment, a barrier, a permanent mark against you. But what have we really learned? We learned that the VA loan program was designed to look past that number. It was designed to look at the person, the veteran, and their entire story. It understands that life happens. Financial challenges happen. But those challenges don't have to define your future. We learned that lenders are less concerned with the score from 3 years ago, and far more concerned with what you're doing right now. Are you paying your bills on time today? Do you have a stable income? Can you demonstrate that you are a responsible borrower now? We learned that your story matters. That a letter of explanation isn't just a formality. It's your chance to speak directly to the underwriter, to provide context, to show that you are more than the sum of your past mistakes. And we learned that while the process can seem complex and intimidating, it's just a series of steps. Get your certificate of eligibility. Find a great loan officer who specializes in VA loans. Gather your documents. Be transparent. And be patient. The VA loan is not a handout. It is an earned benefit. You earned it through your service and your sacrifice. The ability to buy a home with 0 down payment, no private mortgage insurance, and flexible credit guidelines is a powerful tool designed to give you a foothold in the American dream you fought to protect. So, if you're sitting there right now with a credit score you're not proud of, don't close this window and give up. Don't let that number paralyze you. Instead, see it as a starting point. Your journey doesn't end here. It begins here. Your first step is to know where you stand. Pull your real credit reports. See what's on there. Your next step is to talk to a professional, of a savvy mortgage lender who can look at your situation and give you a real game plan, not just a yes or no. Maybe you're ready right now. Maybe you need 6 months to clean a few things up. But you will never know until you take that first step. You've faced far greater challenges. You've navigated situations far more complex and dangerous than a mortgage application. You have the discipline, the resilience, and the integrity to see this through. Don't let anyone, and especially not a 3-digit number, tell you that you can't achieve this. This isn't just about getting a loan. It's about building a future. It's about having a place to call your own. It's about leveraging the benefit you earn to create stability and wealth for you and your family. You earned this. Now go get it.